Hey, everybody, welcome to the show. I am Hans Albrecht. Everything we talk about today is for education, entertainment, and information purposes only. It's your trade, your responsibility. If you're okay with that, and only if you're okay with that, keep on watching. So let's get into it. Wow, the great market crash up of 2026. So we've talked about that over the last maybe 6, 7 weeks about how the volatility to the downside is about a third of the volatility to the upside. Because guess what? Upside is volatility. We tend to think of the VIX being negatively correlated to the S&P. The S&P goes up, the VIX goes down. S&P goes down, the VIX goes up. Hey, that's normal behavior. We're starting to see something a little bit different, and this is the symptomatic things that we're going to talk about today of this melt up are very extreme right now. Very extreme. That gets me a little bit worried. We know that this hasn't been the broadest rally of all time, right? It's basically semiconductors, it's CPUs of late, the ARMs, the Dells, the AMDs of the world. Of course, we've seen things pushing into some of the photonics areas, some of the areas that we've been focusing on for many months now in our programs. But it really is AI specific and maybe a little bit of AI adjacent. Even we're seeing people having moved out of some of the infrastructure names and things like that. Consumer discretionary just getting absolutely hammered. And so there might be some weird stuff going on because we do have this SpaceX IPO apparently next week. And I'm wondering how much of that is going to act as a kind of sucking the oxygen out of the room because in order to raise money to take on that IPO, they're going to put quite a bit of stock into the market, maybe 80, 90 billion. They're going to have to raise money elsewhere. So we're seeing a little bit of weakness in Google, although that's related to a bit of a share issue there. I think that's actually an interesting looking play right there down in the 350s. But we had a nice little bounce back again today. And we closed a lot of positions, really great timing. Snow yesterday for, I don't know, 190%, Dell 427% on a Dell. That was ridiculous. But just know that this is not normal market behavior, right? This is almost as crazy as it gets. It reminds me of .com. I'm not saying it's anywhere close to the fundamentals and the underpinnings behind .com. This is very real. This is a world of infinite compute. But having said that, stocks are going up in a way. Again, Hewlett Packard, Marvell today, stocks popping 35% on the open on just any little bit of news. That is a little bit euphoric. So let's talk about some signs of how strong this euphoria is. Single stock calls are driving option volume. So look at this. Call volume is just absolutely going bananas to the upside. And I showed about a month ago, I showed you the Korean call open interest, really huge, and that upside call skew being very steep as well. And it acted as a little bit of a top, but very briefly. We saw Micron pull back to 650 and then run up over 50% after that. So this has been the Energizer Bunny market. It just doesn't need much of a reason to go up if it's AI related. And you can see that just being driven higher. And what does that mean? When the dealers are being forced to sell, and we can see they are being forced to sell because generally speaking, and I was a market maker for many years, you don't let your vols do something like this. If you have tons of inventory and you can sell it out and you're making tons of money, you're probably on the wrong side of things here. And the amazing thing about this is option pricing in Micron. So this is 360 days. So think of this as 1 year option pricing. Where is the level? Well, 90 implied volatility versus say 60 last year. We are running up, but the amazing thing is, and this has been a recurring thing that I've talked about for 6 or 8 months now, is that we are re-rating those longer term vols because of the world we're in, the world of disruption, the world of anything being able to happen, and companies getting sideswiped and really unusual news. The analysts have no clue what's going on. It's funny, I said that 10 months ago. I said, we're going to get to the point where the analysts are going to be like, I don't really know what's going on. And I think CEOs are like that. I think boardrooms are going, this is just nuts. What do we do here? We've got to get involved in AI. And I think it's starting to push things around. People are over ordering their stuff in the pantries. Remember COVID? We are pantry packing, pantry stuffing, perhaps with microchips and with semiconductors and things like that. So this is unusual to see longer term vols react like this. Look at this. They came down here just for a moment, and then Micron went for another massive all-time high, and those option prices have jammed up again. This is unusual to see that. This is more normal. 60-day, 30-day is going to look like this, but 60-day, 360-day, unbelievable. They kind of look the same here. And part of that is really people are just jamming those calls up there. They don't care. They're paying any price. This is a world of disruption, an incredible age of disruption, and people are expressing it, their upside, by perhaps selling stock, moving into calls, speculating to the upside probably. And this is actually another way to look at it. As you can see, the skew, this is put skew versus call skew. So look here, 3-month 25 delta put versus 25 delta call divided by the call. So you can think of that way out of the money call and that way out of the money put, way out being a relative term depending on what the instrument is. If it's a huge high implied volatility stock, then it's going to be really far out of the money. If it's a column stock, it's going to be closer to the money. So that's a relative term, but it's telling you out of the money calls versus out of the money puts. And you can see that they've absolutely plunged, which means the price of the puts versus the calls has absolutely been hammered. And it's because of this. People are jamming up those upside calls and it's creating very lopsidedness. This is the 0 percentile basically. So it doesn't get much worse than this. Now the blue is the S&P. The Qs are even more extreme, which is incredible because they're responsible for a lot of the run up. And if we do turn around, that could push down. Now, is that possible? Absolutely, because when those dealers, as I started to say, when those dealers are selling calls, they need to hedge. They're getting short, they're short gamma, which means they've got to buy. I did this for a lot of years. They've got to buy stock, they've got to buy futures in order to hedge that upside because you've sold a call for $10 and it could be worth 30 or $40. And the stronger and faster that the move in the underlying stock, the more it accelerates, the more stock you need to buy to catch up. And then add on top of that the leveraged ETF world where we know from videos I've done before, hopefully you guys have watched, we know that they need to rebalance at the end of the day. So those 2-time, 3-time levered products, they need to buy. The bigger the move is during the day, the more they need to move and move into the market and rebalance that exposure so that they get that 2 or 3-time performance the next day. But if things turn back the other way, oh, there's a bird. Beautiful, right there, right on my window. But if they reverse the other way, then absolutely it can unravel in the complete opposite direction. So again, it's a world of vol clustering. It's either relatively quiet, which it has been. We've been just going up, barely down ticking. It's been relatively calm to the upside, but it doesn't take much to turn that around. In all likelihood, down 1% probably gets bought. Down 2 or 3% over a couple days could turn into 5, 6, 7% to the downside. So that's really how I'm conducting myself, is looking for those small dips to create a little bit of exposure, trade this market back and forth. But if things do get ugly, there's a possibility that they could get even uglier. Here's another very interesting chart here. So signs of the gamma squeeze happening out there. So when we look at the VIX EQ, that's the VIX equal weight. That's the individual stocks in the S&P 500 versus the VIX 21. So what is the VIX? Well, it's the S&P index vol, right? So if I've got a stock going up 10%, I've got a stock going down 10%, that sounds like a lot of volatility, but only on an individual basis. If the index is comprised of those two stocks, the index hasn't done anything, and so the VIX of that index hasn't done anything. But you can bet that those two stocks have had massive moves. So what this is showing you is that the moves, the implied volatility of the individual holdings on an equal weight basis. So that's measuring Microsoft the same as any small company. We have seen incredible moves up in volatility in option pricing in individual names, and it's now gone positive. It's gone positive, and it rarely does that. So this is a little bit of a sign of exuberance here. And if you add that to the upside call skew getting blown out, to the volumes that have gone into those calls, it's all kind of part of the same package that is really pointing to a significant amount of exuberance out there. We've been selling our positions, got out of Snows for 190%, out of some Dells for 427%. A whole bunch of other positions we're liquidating. We've got our adaptive close system in Leaps Trader, so we've taken off some other positions. And I think it's time to be a little bit careful. So what I am doing, I put out a big letter midday to members today saying, this is what I'm doing. They already know from my ongoing commentary, but I put it all into one piece. If you join, you're going to get that, my view on where things are going over the next 3 or 4 months. And I think it's going to be a very interesting time. And I think we need to be shifting into some areas that are going to be a little bit more, not necessarily less volatile, but a little bit more dependable for the next phase of this, which I think is going to be a little bit more towards the broadening. We're seeing IWM do very well. Now, it will move. It has a higher beta than the other broad indices, but I believe that there's going to be a little bit of movement in some other areas, and that's how I'm shifting things right now. So hope you've enjoyed that. I will see you guys in the next one.